Good afternoon, and thank you for joining us for this installment of EPIC Insight. This is Brian Lenz, Director of Sales and Strategic Partnerships here at EPIC Retirement Plan Services, and I will be your host. Today we're joined by a very distinguished guest, Mr. John Blossom, the founder of ABG Retirement Plan Services, headquartered in Peoria, Illinois, to offer us an overview of the Secure Act with a focus on its impact on pooled or aggregated plans such as MEPs, PEPs, ARPs, and group trusts. As many of you have hopefully seen, ABG will be joining the EPIC RPS family on April 1st of this year, and we're extremely excited about the depth and quality of the team in Peoria, as well as some of the new services we're going to be able to bring to the table as a result of our coming together. In the next few months, expect more information from us on HSAs, group trusts, wellness, and ESOP solutions that we'll be able to integrate and offer to our partners. Getting back to John Blossom, he's got about every credential you can imagine: MSPA, CPFA, PPC, AIF, RF. He is the founder of ABG Retirement Plan Services, as I mentioned, as well as the Alliance Benefit Group, a retirement plan service organization with 18 regional locations. John has been in the benefits industry for over 50 years and brings a wealth of information to the table. I think you'll find his insight very valuable. And without further ado, we'll turn it over to John to walk through a little bit of the Secure Act and some of the implications for you, our partners.
Thanks very much, Brian. Yeah, I've just got my picture up there for a second. I promise I'm not going to leave it there during the entire presentation, but I wanted it there not to show how beautiful I think I am, but so that you'd know this presentation is not done by a robot. So I can click that properly and get rid of me on that part of it. So that's done. All right. So as Brian said, we want to talk about the Secure Act and look at the aspects of it that are important to advisors and to other producers of retirement plan services, like banks, for example. So I sort of like to begin with the fact that the social and political drivers of the Secure Act were really very, very broad and very important. We all know that there's a significant reason, a significant objective of increasing coverage of American workers in retirement plans and to increase savings rates among American workers in plans. And one of the political drivers with that is that the potentials for pooling participation in plans is a way potentially to reduce costs and make it more attractive for small employers, particularly. And I say small employers, let's say up to 100 participants generally, to establish a plan. So the Secure Act, the Secure is the nice acronym for Setting Every Community Up for Retirement Enhancement Act. Only Congress could come up with something so convoluted as that, but that is what it is. But to give you some insight as to what you may already have, that the amount of emphasis behind this on both parties was that the House of Representatives vote on this particular act was 417 to 3. Which tells you that everybody is in favor of doing what they did. It sort of stalled in the Senate, and there were a variety of reasons why it didn't seem to get to the floor for the Senate. And then all of a sudden, it was added as a surprise addition to a budget bill and was passed and then signed on December 20th of 2019, where many of us have been hoping for something like this to happen, had almost really given up hope, and there it was. So today is a good opportunity. Really, now is the time to understand the alternatives that this presents to all of us, to identify and understand better the target market for these products, and to understand how best brand and position them to the advantage of advisors and other relationships that EPIC serves. And also, to some extent, to consider competitors. We won't talk a lot about competitors, but having this information as an understanding of what we think is there will give you an opportunity to evaluate competitors and their positioning in the marketplace. And then, obviously, ultimately, the big goal for you is to be able to determine some strategic response to the changes in our market, because these things may bring about big change in the distribution system for retirement plans. So the objectives that the Secure Act has are to reduce fiduciary risk for employers, to make it less scary, if you will, to establish a retirement plan, to simplify administration to make it less daunting to have a retirement plan and less irritating, simplify investment management to reduce cost and to add incentives to adopt new plans. So with those objectives, let's first take a look at some of the highlights of the Act itself, some of the things that don't deal specifically with the MEAPs and PEPs and so on. First of all, and these are not in a specific order in the Act because the Act sort of jumps around from different terms, different segments, but things that you need to know as an advisor, and many of you already know these things, but the retirement age, the age for required minimum distributions is increased now from age 70 and a half to age 72. If you hit 70 and a half last year, it doesn't help you. You can't decide to stop and go to 72. But anybody who hits 70, who is older than 70 and a half this year doesn't have to take RMDs until they're 72. It also adds a provision for penalty-free withdrawals for birth or adoption. So couples, for example, who are in a plan, each can, or in a plan or in plans, have the ability to withdraw $5,000 if the event each in the event of a birth or an adoption. And normally, as you know, if those were done in the ages at which most people are going to have births or adoptions, in addition to paying taxes, they'd have a 10% tax penalty. The tax penalty is eliminated. The traditional IRA maximum age, which was 70 and a half, was repealed so that IRAs can be implemented at any time after that. And there's an extended period of time for plan adoption with the idea of trying to make it easier for plans to be adopted so that if an employer is setting up a new plan, they can set that up literally any time before they file their taxes. So if in a January or February or March they're looking at what they're going to be paying for taxes and they decide, oh my goodness, I should have a retirement plan that I should put into place, they can do that so long as that's done up to the time that they actually file their taxes. Now there is a caution there that if we're talking about deferrals, obviously you can't decide in January or February that you want to defer money from last year. So the deferral part doesn't really help you until you get on to yours. But a traditional discretionary contribution plan or permitted disparity, any of those kinds of issues are easy to do. So extended period for plan adoption make it easier for people to adopt a plan. The safe harbor notification that we had to provide to every employee who was in a plan that had a safe harbor is eliminated so that doesn't have to be done. It's one thing off the table in terms of a nuisance or a nuance. And there's an extended safe harbor election deadline, which enables a person to make up until 30 days prior to the end of the year to decide to have a safe harbor election at that time, assuming that they've got a 3% contribution they're making on behalf of employees. And if they're willing to make a 4% contribution, they've got up until the very last day of the year to implement a safe harbor plan. So there's lots of flexibility there, lots of opportunity for us to think on behalf of plan sponsors and what we should be doing. Increased default deferral limit. I'm not sure how much impact this is really going to have on most of us, but if a plan has automatic deferrals or automatic increases, they used to have to stop at 10% of pay. Now they can go to 15% of pay, albeit that's probably not a big part of the people we serve, but it's there. Very important change in the startup plan tax credit. So if an entity starts a plan, that expenses for implementing that plan up to $5,000 will be covered by a tax credit, and that can be done anytime within 3 years of the establishment of the plan. So if you had $1,500 a year for 3 years, that would all be covered by that tax credit. There's also an enhanced tax credit, for employers that establish auto enrollment as a way to stimulate and encourage the use of auto enrollment. And that gives a tax credit of up to $500, and it limited by what the costs actually are. And that applies for 3 years. So it's a big helpful thing as an incentive. New lifetime income rules are there to encourage participants to be thinking more about monthly income from a plan, or income from a plan, rather than lump sums from a plan. And so what's required now as a result of the Secure Act is something that many of us were already doing anyway, is providing an income projection for participants on their statement so that they know not just that they got a lump sum of $400,000, but they know what that will do for them in terms of income. It also added a fiduciary safe harbor for companies that wanted to have an in-plan guaranteed income settlement. And so many people who were thinking about doing that kind of thing were reluctant to, because they feared the fiduciary impact of, what if I pick an insurance company that's not around in 10 years? And so they added a safe harbor that takes care of that, although there's more to say on that topic beyond just that safe harbor. One thing that you might look at initially as a negative is that part-time employees who used to be able to be excluded from plans now must be included as being allowed to make deferrals for plan years after 2020. So that doesn't start until years after 2020, and the people who are eligible for that to be allowed to participate requires either 1 year of 1,000 hours or 3 years consecutively with 500 hours per year. But there's no matching that's required for those people. They can be excluded from non-discrimination testing, from coverage testing, and from top-heavy plan rules. So while it's nice they're going to be brought in, there is really not much of a negative impact on most employers when they do that. And I say that they don't, obviously they could make matching, but they don't have to do that. And one of the ways that Congress decided they're going to pay for the whole act was to eliminate stretch IRA distributions, which would increase the revenue receipts to the Treasury Department, and that supposedly pays for a large part of the program. And it implements widely important new rules for pooled employer plans, which I want to spend really most of my focus on. So let's take a look at that. Advance my slide here. There we go. So there are a lot of possibilities. This is a whole cluster of possibilities. Potential destinations in our discussion, or your thinking, includes MEPs, open MEPs, ARPs, PEOs, PEPs, and GOPs, which is not a Republican designation. So where does this all go? Where does it all take us? First and foremost, it takes us to talk about MEPs, multiple employer plans. And as the screen talks about, a multiple employer plan is a single retirement plan that can be adopted by employers that are not part of the same control group or affiliated service group. And the Internal Revenue Code creates special rules for service crediting of people in that kind of a plan that you want to be aware of. That what that is that service in any organization that's part of the same MEP must be credited as service for every employer. So if I worked for employer X that's in the MEP and went to employer Y in the MEP, my service credit would date back to working for X. And compliance testing is done for each plan. So even though they're all aggregated together in plans, that the testing for purposes of eligibility, for discrimination, for top-heavy, those things are tested plan by plan. In 2012, the Department of Labor issued an advisory opinion that really scared everybody to almost a dead stop on MEPs, because it really said that you have to have commonality of the employers in a MEP before it would really have the single plan status. And there was also a thing that I think many people call the bad apple myth, which is a myth that if one employer in the plan had a problem that was a default problem, that was a disqualifying problem, that might disqualify the whole MEP. That's never been done by the Internal Revenue Service in all the years these things have been around. So it is definitely a MEP, but it was a deterrent, a reason that people thought, well, maybe I shouldn't do this. So the impact of the Secure Act is going to be, and I'll show you in just a moment, more depth, but it's going to change those. But in any MEP, the plan sponsor doesn't get rid of the total fiduciary responsibility for having a plan, because they retain very explicitly the fiduciary responsibility for plan selection and for monitoring of the provider to be sure they're doing what they said they were doing. So let's look at a couple of possibilities or ways that this can get structured. First and foremost, Association Retirement Plan, ARP. That's a plan that's sponsored by a valid group or association of employers. It's got to be a valid group that's people that came together for something beyond the retirement plan interests. And it has to have true governance. It's got to have people who are in charge of it and run it, and board, and so on. But in that, with an association retirement plan, the commonality is much more broadly defined. Could be employers of the same trade, same industry, same line of business or profession, or employers that have this principal place of business in the same state or the same metropolitan area. Well, so there's some much broader possible coverage there. And the significant advantage of this is that just like some of the others I'm going to show you, has a single plan filing for the Form 5500. The 5500 is filed for the plan, not for the individual plan sponsors. So instead of having a 5500 they got to deal with, the plan does it. And then individual plan compliance tests, again, the eligibility, discrimination, top heavy, all of that's done is assessed at the individual level. And then ARP may not be a bank or a trust company or a broker dealer or a similar financial service firm. The preamble of some of the act and some of the information on the topic really talks about the fact they're a little suspicious that people of that nature might assemble a plan and take advantage of the people they brought into the plan. We don't think that would happen, but obviously that it is a provision. And again, the plan sponsor retains the fiduciary responsibility for selecting the plan they're going to be in and monitoring how it's working. Other options as a PEO, a professional employer organization, and PEOs were really big winners in the Secure Act because it was made very, very clear that an organization that contractually assumes certain kind of responsibilities for the employer, like payroll, health insurance, recruiting, hiring, and gets retirement plan single status. So it's treated as one plan, even though many employers might be part of it. The PEO controls the functions and the activities of that as the plan sponsor, with ERISA 316 responsibilities as the plan administrator and as the ERISA named fiduciary. And again, like I'm going to get redundant in saying this, but it's important that the employer retains fiduciary responsibility for plan selection and monitoring of how that's working. The next thing that's really the biggest thing that's attracting much of the ink and much of the discussion on this topic is PEPs, pooled employer plans. And what that is, that is effective and available for plan years beginning after December 31st of this year. So it's not effective now, but it's available for plan years beginning after December 31. It requires a PPP, a preferred plan provider, a pooled plan provider, to really be the one who operates it. No commonality is required. It's a fully open MEP. You can bring in anybody that you want to bring into it. There is no one bad apple rule, but there are really arduous notices and follow-up processes that the sponsor of a PEP that the PPP has to follow. So no one bad apple, and also of great significance that PEPs, as it stands now, are for 401A plans only. They are not allowed for 403B, 457, or in any kind of DB plan like a cash balance, for example. But they do have the advantage of having single plan treatment, and a global Form 5500 is filed on behalf of the whole plan, not just the individual participants. And fidelity bonding is done at the whole plan level rather than individual plans. But again, individual plan compliance testing. Is eligibility working okay? Is discrimination, passing discrimination tests, ADP, ACP, and those kinds of things are still in effect. But it does also give a single investment pool, which has some potential advantages that we'll hit again. But again, being overly focused on this one thing, plan sponsors retain the fiduciary responsibility for selecting and monitoring of those. And as I said, a pooled plan provider is required to be the plan administrator, the named fiduciary, and may also be the investment advisor of a PEP. They're responsible for all the administrative duties, just like a normal plan sponsor is responsible for operating all the administrative duties of their plan. In this case, the PPP takes on those responsibilities. They're responsible for coverage and discrimination. They can designate a different trustee, and they're responsible for fidelity bonding of all fiduciaries. And they have to register with the DOL, and we don't know what the rules are going to be yet, but they have to register with the DOL and the IRS before they begin to act as a PPP. Now, great significance, they can appoint and remove designated service providers. So if you happen to be the investment advisor that's selected by a pooled plan provider, they can select you to do that. They can select a record keeper like EPIC to be the record keeper, and the trust or who the trustee is going to be, and if they're going to be 316 services, who provides those and how they're done. But that also means they can replace them in the cycle because it's just like a plan sponsor. That's their plan. Next segment is the group of plans that I use the acronym GOP on. A group of plans, the regulations set these up as not being really available until the year 2022. Regulations to be announced, but the advantage of a group of plans is that they, similar to a PEP, have a single consolidated Form 5500, and it may be a simplified Form 5500, but regulations are to be determined on that, but it's out there in 2022, may be helpful. But to make that a group of plans subject to these rules, all the defined contribution plans that are in it have to have all the same trustee, all the same named fiduciaries, all the same plan year beginning date, and all the same investment options. So it may be a little awkward to make that actually work. And again, the plan sponsor is responsible. So let me turn to the next option, which is kind of candidly my favorite, which is, I think, being called in the vernacular, anyway, that's the wrong term, but a MEAP. So what is a MEAP? A MEAP is a multiple employer aggregation plan. I've seen that term used by a couple of the major insurance companies that have products that are now being distributed in this space. But a MEAP is available now. It uses a pre-approved in the EPIC and ABG setting. It uses a pre-approved IRS plan adoption agreement, a volume submitter document that sets up the specific provisions for the plan. It operates under the auspices of IRS Revenue Ruling 81-100 for the investments which are held in a master trust. That master trust can hold 40 Act mutual funds or ETFs or collective trusts. And very importantly, a MEAP can be applied and used with 401k plans, 403b plans, and 457b plans. And all of those can be aggregated in a single 81-100 master trust, getting scale, getting economy of investing in the process. Also, the plan sponsor in this kind of setting has the ability to, or the plan sponsor, the people who have engineered it, have the ability to delegate the fiduciary duty. They might pick a discretionary trustee or have an ERISA 338 investment manager, or both, to minimize, as you know the rules, to minimize significantly the fiduciary risk that an employer might face regarding the investments of their plan, which is where the biggest risk, of course, is. Also, the design of such a beast like this can include optional 316 services to the extent that the plan sponsor wants to build them in. So the plan sponsor determines the plan design options. They can limit the options or can be real flexible. Obviously, the more limited they are, the less expensive administration should be. But they can decide on what the options are going to be, determine the record keeper and TPA, generally the same entity, but it doesn't have to be. pick a trustee and an ERISA 338 investment manager, and or an ERISA 321 investment advisor, who provides services to the plans in the MEAP. The things that an investment advisor, or in the bank sort of trust setting, the bank trust setting can be providing, can be serving as an investment manager, can be providing an advisor managed risk-based portfolios, which I think are a growing thing of interest in the plan marketplace, and for an advisor to be able to have their prowess shown by creating those portfolios. And also plan level investment advisor services. So you might have everything is set up with the 338 and discretionary trustee, but an advisor who doesn't want to have the responsibilities for doing more than serving participants with their investment needs can do so as an ERISA 321 under this device. It is eligible for the startup tax credit, and it also, you might want to convert something like this if it really had all the things similar to the group of plan status in 2020, if in fact the cost of creating a 5500 was burdensome, which I don't think it really is as much as the people might think it is, but it can be eliminated in 2020 by that particular thing. And again, the plan sponsor retains the fiduciary responsibility for agreeing to, okay, this is a good idea, I'm going to do it, and for monitoring that it happens. Now, I'm not going to go into a bunch of detail about this because I would bore some of you to death, but the 81-100 Group Trust was created, as the numbers tell you, Revenue Ruling 81-100 in 1981 by the Internal Revenue Service, and there are 8 specific requirements which are on the slide here, and I'm sure that Brian will tell you after we're over how you can get a copy of the specific slides we've used today. But those 8 things are musts, otherwise it is not able to aggregate assets and be, in fact, an 81-100 Group Trust. Also, there are some issues about when you're aggregating assets for multiple employers within the same trust. There's some issues about aggregation of that fall into the Investment Company Act, and there's a specific exemption, the Investment Company Act, Exemption 3C11.5, as you see says that any collective trust fund maintained by a bank consisting solely of assets of one or more such trusts qualifies as an 81-100 trust. So that's kind of the backbone that holds the investments that protects the plan sponsor. So I said at the beginning of this that the objectives for these devices were to be able to reduce fiduciary risk, and all of them do that in varying degrees, but all of them get to the same place, that an employer can reduce their fiduciary risk significantly in establishing a plan. They still have the responsibility of who they picked and why they picked them to do some due diligence. Give them the ability to simplify administration by streamlining options in the adoption agreement, for example, to simplify investment management. One of the tools in the 81-100 is that once a particular fund is in that 81-100, even if there's a soft close of that fund, and the plan fund continues to be available. And more importantly, is that by aggregating assets, we may be eligible to purchase things that will enable us to reduce cost. And of course, the streamlined administration also leads us to reduced cost. All of which should create some significant incentives for all of us to be able to adopt new plans and serve our clients even more efficiently than we ever did before. So that's my story. And I know that Brian and the whole EPIC team are eager to serve your needs in terms of follow-up questions or interests. One of the things I have put in my slide deck here are some key considerations that will be thought-provoking for you in thinking about this whole issue of what I want to do about it. For example, the question, what's your primary reason for consideration of sponsoring a retirement program? What's the target market? What demographic do you have? And other related things. So I won't go through those things, but I think they can be helpful to you in thinking about that. So, Brian, I want to turn it back to you. I've said everything I know.
All right. Thank you very much, John. Appreciate that insight. And we will open it up to a few minutes of questions here. If you have those, please enter it into the GoToWebinar questions panel. John and I would be glad to discuss those with you. While you're entering those, I will say that we're very actively at EPIC RPS and collaborating with John and his team, digging into the implications of the Secure Act and digging into these various pooling structures to make sure that we're positioned to support the ones that will best serve your needs. So we certainly welcome the opportunity to chat with you and consult with you on a lot of these key considerations and what might help your business grow. And please do reach out to your sales consultant or relationship manager to begin those conversations. We'd love to hear from you.
Brian, if people would like to have a copy of these slides, where would they get them, and is the presentation recorded?
Yes, on both accounts, we will, as always, send the recording out as well as the presentation deck to any of you who registered, and feel free to share that with your colleagues. So expect later this week to get that via email from us so that you have it to access at your leisure. John, one question that's come in relates to the pooled plan provider status. Obviously, we're awaiting forthcoming guidance, and obviously MEAP doesn't even exist yet. Have there been any grumblings on what potential criteria might be to become a pooled plan provider? Has anything leaked, if you will, on what it would take to sponsor and start up a PEP?
I don't have any real inside information on that topic, but there is quite a bit. There's some discussion of it in the preamble of the act and of the preceding information that came from the DOL, and basically looking for the financial ability to get the job done, and so I mean it's of those things. But certainly, an individual record keeper could create or could become a PPP. At least it appears that on the surface. We'll know more about that later. Whether or not that's a good business judgment, because when you really be able to gather the scale to make that work effectively, that's why those key considerations I put with our deck may be helpful to you.
Sure. And again, we'd be glad to kind of dig into some of those implications with all of you on the phone if you're interested in becoming a PPP or partnering with us as a PPP or leveraging a group trust, which, as John said, exists today and we do have up and running. It is admittedly complicated, and we'd love the chance to talk through it with you.
And it is something that the group trust can be used by any bank in their trust operation, or any advisor. Would be easy to fit that into that.
Excellent. Well, with that, thank you again, John, and we're excited to have you joining the EPIC RPS family. Thanks to all who tuned in today, and we'll look forward to seeing you on the next Insight webinar. We appreciate the partnership, and we'll talk to you all soon. Thank you,
Brian.